Okay, so good morning. Final day of the first half of 2015. H1 coming to a close. So we'll have a look at some sort of year-to-date performance. Also, as you will know, we get 1 second added to the clock today. So this means we get a lie-in. Tomorrow we can enjoy a whole 1 second more in bed. Looking forward to that. If you're interested in that kind of stuff, it's about the Earth's rotational axis or rotational movement slowing anyway. It might actually carry implications for, believe it or not, high frequency trading systems. Will's going to be on the BBC actually at 10:30 this morning talking about this, so we'll take a look at that later. But of course, it's not about 1 second. It's not about the end of H1. Of course, it is today about Greece and I would say 99.9% likelihood that they will not make their payment to the IMF. It's due at midnight our time. This is when the IMF closes for business in Washington. The money has to be there, 1.6 bill, and they don't have it. So they're not going to pay. So this is the day where Greece move into arrears on their IMF debt repayments. As it stands, it's most likely not, and this isn't for sure, and it's very complicated, and it's you have to move into kind of legal territory to look at wording and so on, but it's most likely not going to be seen as a default event, so it probably will not carry implications for debt that is outstanding to the Eurozone, for example, or debt that's outstanding to the ECB. It will, this missed payment on the IMF will not be seen as a default. That would not be the case, however. They've got a 3.5 billion euro bill to pay the ECB in July. If they miss that, that is absolutely 100% a default. That's a goner, but that's obviously a couple of weeks down the line. So this is how markets have opened this morning. The DAX is down 1.2%. Similarly for Eurostoxx, actually Eurostoxx a little bit better off, down just the 1%. We've got Bunds higher. And what's happening here is that, I mean, it was a strange session yesterday, and maybe the DAX is the best market to look at to kind of just remind ourselves what happened. All the action really in terms of the risk off came at the open, untradeable. Then we then spent most of the session pushing higher, and the DAX made it up to 11,293, putting that at a, not far off a, wow, let me get my maths right here. That's, what's that, a 350 point rebound. Then as we went into the European close, a lot of that was given back, and we kind of closed, cash close around about mid-range for the session. Markets down, DAX down over 3%. The periphery took the biggest hit, of course, the Italian stock market down over 5%. And what's happened this morning, we've just drifted below the lowest point of the sell-off into the last night's close, with around 11,000 handle. The DAX managed to just pop higher. It closed below 11,000 last night. We're coming into today's session. I would say it's very likely we see these European equity markets test yesterday's lows. Okay, so that's the opening lows from yesterday's session. I think I'd be surprised if we didn't get down there and have a look. What happens down at that point, we'll see at the time. Well, assuming we get there, obviously. So definitely more risk off today after a very strange session yesterday. Why have we got more risk off today? I mean, what was yesterday all about? Why did these markets regain a lot of those opening losses? And really, two potential reasons why the DAX bounced yesterday. Reason number one, traders think that the Greek people are going to vote yes, and they're going to agree to, they're going to go vote yes in the referendum at the weekend. And so, all this uncertainty and risk will go away, and Greece will sign up for more Troika-led austerity, and the default scenario will be avoided. That's one reason. The second reason is that traders don't think a Greek exit carries that big a risk for the wider European markets. So these are two potential reasons. I would say there's probably people in both camps, but let's talk about reason number one. That is that traders think that Greece will vote yes. I think what's happened yesterday, the kind of second half of yesterday and what's happening this morning, is perhaps traders beginning to change their mind on that, or at least saying actually it's going to be a lot closer than we think. And the reason for that is the way the Greek government have worded the referendum. This isn't a vote to stay in the Eurozone. If on Sunday the Greek referendum asked one question, should we stay in the Eurozone or not, the Greek people would vote yes. I think that would be a fairly high certainty of that. That's, I think, what traders were kind of trading for yesterday morning on the rebound. However, they're not going to be asked whether they want to stay in the Eurozone or not. They're going to be asked, are you willing to accept the creditor deal? Do you want to sign up for more Troika-led austerity?
Unemployment data. So it's for the month of June. So unemployment change.
And so the wording, I think, changes things. Also, on the ballot paper, the first option, the top option, will be no thanks. And the second option will be yes, please. So I think what's happening this morning, what happened in the back end of yesterday, is that the perhaps realization that, okay, this isn't a vote for Europe, this is a vote for the creditor deal. Now this gets interesting, because some of the comments overnight, which again have helped with the nervousness this morning, is some Eurozone leaders actually saying, you know what, Greece, this is, or trying to get the message across to the Greek people that actually this is a vote for the euro. Because it's maybe some of these European leaders saying, look, if you don't agree on the deal we've got on the table, that deal's not going to get any better, and that's your path to default and exit. And so Europe are trying to steer a message to the Greek people that actually this is a vote to stay in the euro. The Greek government, of course, are not. And Tsipras last night on TV was basically saying, vote no. This will then give us a much stronger position when we return to the negotiating table to negotiate a better deal. This is what the Greek government are selling to the Greek people. The idea, this has got nothing to do with staying in or out of the euro. This is just a part of the negotiating process for an extension in funding. And the Greek government is saying, look, vote no. We'll take that back to the negotiating table and we'll get a better deal. It's just that I think they've miscalculated grossly, and I think they've miscalculated perhaps throughout this process. I think that there is no better deal. I don't think they're going to get anything better, and I think that's why some of these European leaders are saying, listen, what's on the table is as good as it's going to get. You can vote no all you like, but if you do, that's your path to default and exit. So I think what's happening this morning then is a bit more uncertainty surrounding the outcome of the referendum and what happens after that. I mean, the uncertainty is very high. We don't really know what happens if they vote no. Will the creditors be stubborn and say, look, we've given you the best deal? What happens if Greece default? That actually doesn't mean that they're going to leave the euro and the eurozone. So there's a lot of uncertainty, and I think that this morning it's just more about the chance of a no vote given the question the Greek people are going to ask or be asked. Of course, bond markets yesterday took a lift, none more so than Greece. There's a great graphic in the FT this morning. Let me just put it on the screen here. One sec. This is the graphic. They've got a chart of Greek 10-year government bond yields yesterday. The red line is actually the chart of the yield, and you can see the yield last week was around 11%, and then bang, huge jump to the upside, up to 15%. And of course they've backdropped this with the coin of the euro with the drachma underneath. So is this Greece inching towards a return to their original currency? So of course bond yields in Greece obviously exploded yesterday, but also in peripheral Europe. So we saw widening of spreads between the peripheral European debt space and safe haven debt. So, of course, you saw German debt yields drop. You saw that on the Bund. But also you saw other safe haven European core markets, saw their yields drop, the likes of Holland and Sweden and Switzerland, for example. All of these yields dropped as money came out of peripheral bonds. So Portuguese, Spanish, Italian, all these yields went up. The core yields went down. So a widening of the spreads in Europe, a decent sell-off in the end in European equities in what was not a straightforward risk-off. But when you look at the stats at the end of the day, of course, you see, well, that's straightforward, right? Stock market's down, bonds up, no-brainer, except that, of course, it was far from straightforward from a trading point of view. In fact, really, the only way you could have made money in European stocks yesterday for most of the session was buying them. I don't think that's going to be the case today. We've got to talk about the euro. What a remarkable day. I mean, this really does... Well, it defies gravity, it defies belief. The euro gapping down at the open, trading down below the 110 handle, turning and then doing nothing but rally, and actually into the end of the session rallying hard and actually shooting up above Friday's levels, up above Thursday's levels. Quite remarkable. Two reasons, I would say. Reason number one, this is international investors removing exposure to European equities. If they do that, well, one of the things, if you're an asset manager holding euro-denominated assets in your portfolio, well, you're worried about exchange rate risk. And so to hedge against that, you go short the euro. That's an FX hedge against an underlying portfolio of euro-denominated assets. But if you're selling these euro-denominated assets, so if you're coming out of European equities because of the Greek risk, you don't need your hedge anymore, so you close out. You close out your short euro hedge, which of course means the euro goes up in value. That's one reason. There's another reason which is pretty interesting, I think, and that is that actually the Greek risk perhaps carries a larger implication for near-term Federal Reserve monetary policy than it does for ECB monetary policy. If Greece default, well, maybe we ain't getting a September hike from the Fed, we'll get a December one. But if Greece default, well, the Eurozone, well, they've already got rates at zero, but they've already got a monster QE package in place already. Of course, the European Central Bank could choose to increase that QE package, but they'd only do that if there was obvious signs of notable contagion across the Eurozone. And whether that's going to happen or not, I think there's a big question mark. So it's a bit weird that actually Greece could change Fed policy more than it could change the ECB policy. So perhaps a bit of dollar weakness maybe in the mix yesterday on the idea that Greece will lead the Fed to prefer to wait. So there's a couple of things to think about. The euro is under a bit of pressure again this morning. I would say this idea of people closing out their euro hedge shorts is probably nearly done, I would say. And actually this has been a feature in the market over the last few weeks, but I think notably yesterday. But I would say the ability for the euro to rise off Greek risk, I think that ability is probably almost exhausted. But I do think this still remains a very tricky currency to trade in this crisis. So, this is the backdrop, all right? We've got Europe trying to tell Greece, look, this vote on Sunday is to vote to stay in the euro. You've got the Greek government saying, look, the vote on Sunday is just to vote whether you want the current proposal or not from the creditors, and if not, and we think not, vote no, and then we can take that back to the negotiating table. I think Greece have miscalculated if that's their tactic, so we'll see. So I think a little bit of nervousness this morning because of the risk ahead of the vote. Other things happening. Let's talk China before we get into the S&P a little bit more. So China overnight. Actually, I haven't got to read. What's the Shanghai Composite Trading Bill? Let me just get my 3.5% down. Oh, up. Right. Okay. So the Shanghai Composite's 3.5% up today. What a wild period it has been. I mean, it was down 5% earlier at the open. It's now up 3.5% coming into the close. So stocks all over the place. There's been rumours flying around that the Chinese government is really going to start to step in and make measures to control this frenzy of profit taking. So we had finance and social security ministries in China jointly publishing draft rules that would permit the state pension fund to invest in stocks. This could potentially release, well, in dollar terms, about $100 billion worth of funds to get channeled into Chinese equities. This isn't official. They are thinking about this. They're publishing draft rules. This hasn't happened, but this is perhaps a way of China's government trying to control the panic here a little bit. Maybe that's helped to just stem the flow, or the heavy downside, of course, that we've seen of late. The Chinese composite down 20% in the last week or couple of weeks into bear market territory. So eyes still very much on China and on the bull run that's kind of spectacularly coming to an end, and whether or not the Chinese government have the ability to actually control things. Now, looking at inflows to Chinese ETFs yesterday, there was actually a net inflow. This is yesterday, despite the market closing down 3.5%. It was down 7% at one point, but apparently there was a net inflow of 95 billion renminbi into blue chip ETFs. Now, apparently, this is according to local media speculation, the inflows may have come from a subsidiary of the Sovereign Wealth Fund that holds stakes in major domestic financial institutions. So there's a chance that China's government are really ramping up efforts to try and control things. The only problem they've got is they tried to use the central bank to do this over the weekend. So they cut rates, they cut the reserve requirement ratio, and equities still dumped. Now they're going even further, dramatic measures to try and contain it. Now, if this doesn't work, if you get more downside tomorrow, let's say, or into the end of the week, then I think they've got a problem, because they're kind of trying everything they can, but we'll see whether or not this can cap the downside or not. Let's talk about the S&P. I just want to look on a yearly chart. So check out the candle for this year. Notably absent of any body to this candle. This is a classic doji. We are halfway through the year and the S&P hasn't moved. It's actually up 0.24% in 6 months. If anybody knows anything about candlestick charting analysis, this of course is a reversal pattern. The only problem is we've got 6 months for it to actually complete before the candle actually closes. But as it stands, the S&P back to flat on the year. Downside yesterday in the order of 2%. That's the biggest sell-off in over a year, actually. Gapping down through some of these key bottoms, the June low, then taking out the May low. This was a sell-off into the close. Now, where we're trading back to, this is on a continuation chart, we're trading back up to around about the May low here. So this is quite an important territory for the index and may well kind of shape price action for the session, but I would say there's a decent chance we can see what's a very important triple bottom that was set back in March around 2032, 2033. Very important triple bottom. So we'll see. Maybe not. I'm not saying we're going to get down there today, but maybe into the end of the week. The DAX has just lifted back to 11,000. But I think when we get some opinion polls coming in to kind of tell us about a better insight into how the Greek people are going to vote, I think the problem with the question they're being asked is a lot of them. I would say a lot of the Greek people don't really understand the technicalities of a bailout program and the often quite complicated fiscal process of austerity. And so you're really asking a nation a question they're not really they're definitely not qualified to answer. And so this is why I think when Tsipras gets on TV last night and says, look, come on, get out and vote, we want a really high turnout, the more of you that vote no, the more chance we'll get a better deal negotiated at the negotiating table with the Troika. That's what he's saying, and I think that's believable if you don't understand the situation in its wider context. How much of this commentary from Europe, the European leaders saying, look, actually this is a vote for the euro, how much of that is filtering into the Greek press? I don't know. I'll have to ask Vas, my in-house Greek expert, to just scan Greek media from this morning to see if there are any stories being run about these European leaders telling the Greek people this is a vote, this is an in-out vote. Alright, so this is the backdrop to the session. Very interesting times. Now let me show you the calendar for the day. So here we go. We've already had some figures like German retail sales came in better than expected, plus 0.5% for May this is, so it's a bit old this data, but plus 0.5%, we had expected 0, so better than expected. That's on a month-on-month basis. However, on a year-on-year basis, it actually came in a lot worse. We'd expected plus 2.8% retail sales growth May 2015 compared to May 2014. It actually came in at minus 0.4%. So very mixed data there. I would say the big data of the morning comes at 10 o'clock. I'll talk about that in a sec. Before that, though, we do have German unemployment and labour market data at 8:55. But it's let me just adjust this. So it's actually we've already hit. Sorry, apologies, I'm a bit late here. We've had the German unemployment change coming in at minus 1,000. That's worse than the expected minus 5,000. The bigger the negative, the better. So slightly worse than expected. There's hardly anything in that. The unemployment rate stays unchanged at 6.4%. But to be honest, this is kind of irrelevant stuff. The German labour market's fine. We don't need to worry about the German labour market. We do need to worry about Greece. We got UK final reading for quarter one GDP at 9:30 is expected to get marginally revised higher to plus 0.4%. That's at 9:30. Then the big data of the morning is the Eurozone inflation data for the month of June. Okay, now we had some German figures yesterday, and on a monthly basis, certainly they were lower than expected. What's expected today is plus 0.2% year on year. Just have a look at the chart here, looking at the inflation rate, the headline CPI in Europe over the last 12 months. We've seen a really strong rebound over the last sort of 4 months. This has really been a very influential development on markets. When you're thinking about German bond yields, for example, and how they lifted sharply, a lot of that, or some of that, was certainly as a result of this very surprising, very rapid recovery back to positive territory. The only problem with today's figure is it's expected to be lower than the month before. That will be the first time in 4 months or 5 months that we've had an inflation print that goes down. So plus 0.2%. This, of course, brings to an end this rebound. And where do we go from there? This puts the inflation readings in the next couple of months, I think, very important. Does inflation creep back into negative territory? Or not? We'll have to see what the data is today, of course, but it's likely to be 0.2%, if not lower. It may even be 0.1%, just looking at the German figures from yesterday. And so that's something else you've got to factor in when thinking about bond yields in Europe, when thinking about the value of the euro, when thinking about ECB policy. So you've got a whole cocktail of factors. You've got to think about Greece and speculation over this vote at the weekend and what's it going to mean if they vote no, or what's it going to mean when they vote yes politically. You've got to think about how does the Greek risk affect the Fed's decisioning on the rate hike. You've got to think about China and the turmoil in China's stock markets. We do have other data from the US this afternoon. Most importantly, Chicago PMI coming in at 245. Okay, that's the big figure. We have some minor housing data from Case Shiller as well at 2 o'clock, but it'll be the 245 Chicago PMI number that will be the most important. Okay, so that's data coming later on this afternoon. Okay, so let's see how we get on. Final session of H1 2015. Enjoy.